ETF. It's everywhere in Bitcoin right now. But what does it actually mean? I'm Sats. Let's break it down. Right. But let's start with the basics. What even is an ETF? ETF stands for Exchange Traded Fund. And before your eyes glaze over at the finance jargon, let me give you a really simple version. An ETF is basically a wrapper. It's a product you can buy on a normal stock exchange, like you'd buy a share in Apple or Tesco. But instead of buying the thing directly, you're buying a product that tracks it. The ETF does the holding. You hold the ETF. There are ETFs that track gold. You buy the ETF, and the company behind it goes and buys actual gold and stores it. The price of your ETF goes up and down with the price of gold. Simple. A Bitcoin ETF works exactly the same way. You buy the ETF through your normal brokerage account or investment platform. The company behind it, in Bitcoin's case, big names like BlackRock and Fidelity, as it goes and buys actual Bitcoin and holds it. The price of your ETF goes up and down with the price of Bitcoin. You never have to touch actual Bitcoin directly. No wallet, no private keys, no worrying about seed phrases. You just own a financial product that tracks the Bitcoin price. So why is this such a big deal? Why has this been all over the news? Before Bitcoin ETFs existed in the US, and they only got approved in January 2024, if a big institution like a pension fund, a hedge fund, or a major bank wanted to get exposure to Bitcoin, it was complicated. They'd have to buy Bitcoin directly, figure out how to store it securely, deal with custody issues. Most of them just didn't bother. The ETF changed all of that. Suddenly, a financial advisor at a major bank could say to a client, here's a regulated familiar product that gives you Bitcoin exposure. And the client could buy it the same way they'd buy any other investment. No new accounts, no crypto exchanges, no private keys. This opened the floodgates for institutional money. In the first year after US Bitcoin ETFs launched, billions of dollars poured in. Goldman Sachs disclosed over $1 billion in Bitcoin ETF holdings. BlackRock's Bitcoin ETF grew to nearly $100 billion in assets, faster than any ETF in history. That's an enormous amount of money that might never have touched Bitcoin otherwise. And when large amounts of institutional money flow into Bitcoin, the price goes up, which is a big part of why Bitcoin hit that all-time high of over $126,000 last October. You've probably also seen headlines about ETF outflows lately, money leaving Bitcoin ETFs. And as we talked about in the last video, that's been one of the factors pushing the price down. When institutions pull money out of the ETF provider has to sell Bitcoin to cover those redemptions, which increases sell pressure on the price. So ETF flows, money going in and money going out, have become one of the key signals people watch when trying to understand what's driving Bitcoin's price at any given moment. Now, the important question for you, do you need a Bitcoin ETF? Honestly, for most beginners, the answer is probably not right now. Here's why. The main appeal of a Bitcoin ETF is for people who already have investment accounts and want Bitcoin exposure without dealing with wallets, exchanges, or the technical side of things. If you're a pension fund manager, that makes perfect sense. If you're an individual who already has an ISA or investment account and wants to add a slice of Bitcoin without setting up a crypto account, an ETF could be a simple way in. But there are trade-offs worth knowing about. With an ETF, you don't own actual Bitcoin. You own a financial product. That means you can't use it to send Bitcoin to someone, you can't hold it in your own wallet, and if the ETF provider went bust, though that's very unlikely with the major ones, there's a layer of counterparty risk that doesn't exist if you just hold Bitcoin directly. There are also fees. ETF providers charge a small annual management fee, usually somewhere between 0.2% and 0.5% a year. That sounds tiny, but over many years it adds up. And you can't move it off the platform. One of the things that makes Bitcoin genuinely different is the ability to be your own bank, to hold your own keys and have full control. With an ETF, you're back to trusting a financial institution. So, the way I'd summarize it, Bitcoin ETFs have been a massive deal for bringing institutional money and mainstream legitimacy to Bitcoin. They're a valid option if you want simple, familiar exposure. But if you want to actually engage with Bitcoin the way it was designed, owning it directly, controlling your own keys, sending it wherever you want, then buying Bitcoin on an exchange and using your own wallet is the more self-sovereign approach. Neither is wrong. They're just different tools for different situations. All right, let's land this. A Bitcoin ETF is a financial product you can buy on a stock exchange that tracks the price of Bitcoin without you needing to hold Bitcoin directly. They launched in the US in early 2024, opened the door to institutional money, and played a big role in Bitcoin's rise to over $126,000. ETF flows, money in and money out, are now a key driver of Bitcoin's price. For beginners, buying Bitcoin directly still makes sense for most people, but ETFs are a legitimate, simpler option if you already have an investment account and want exposure without the technical setup. Thanks for watching. If this helped you understand Bitcoin better, consider subscribing. I'll see you in the next stack.